Hello. Hi, everyone. Welcome to this webinar. Today we're together for 45 minutes and we're going to talk about asset-based data. My name is Michel Amar, so I'll be your host today. First I would like to thank you all for joining and attending this session, and I hope it will be useful. So at the end of this webinar, we hope you'll get a better understanding of asset-based data, what it is, how it's addressing some issues, and how it can support you in your climate analysis for different type of organizations, so financial institutions, as well as non-profits or even consultancies. So we'll hope you'll get a better insights into that at the end of the webinar. So today we're gonna have a panel discussion. So in the first 30 minutes of the webinar, we're gonna talk about first let's say the why, what issues asset-based data is addressing and what it is and how it's structured. Then we're gonna address what kind of climate indicators we are building on an asset-based basis. And the third main question of the panel will be about the use cases and how it's used and supporting organizations. Then we're going to open the webinar to questions from the audience. So I think on the lower right of your screen, you must see a chat box. Feel free to post questions during the webinar, and at the end of the webinar, we're going to address them. We have already received some questions during the registration process. Questions we will not have time to address. We'll also send you answers separately by email. So really feel free to ask any questions you may have. And after the webinar, you also receive an email and the recording from the webinar. So no worries about taking notes. We'll send you all this at the end. So without further ado, I'll start the panel discussion. So we're going to start with the introduction of the speakers. So let me start with Meishwan. So Meishwan, can you briefly introduce yourself and your organization and the role you're having?
Yeah, thanks, Michel. Hi, my name is Meishwan. I'm from ING, so ING, the bank in the Netherlands. And I'm from Global Sustainability, which is a strategy department directly under CEO. And we are a department that hosting many topics. Climate is been one of them. And we have this approach called Terra approach, which is our climate alignment strategy. It's about how to bring ING towards our net zero banking alliance commitment. Yeah.
Thank you. So Vincent, can you also briefly introduce yourself as well as asset impact in a few words?
Yeah, happy to do that. And thanks for the introduction, Michelle. So my name is Vincent Josh Herald. I'm Asset Impact's Chief Product Officer at Asset Impact. I'm responsible for our product strategy and development process. And we've been working with ING for many years now. So I'm really excited to have them on this webinar and share a bit more about their process and insights they get from asset-based data.
Thank you.
So I prepared a few slides just to quickly introduce asset impact. And I think probably the most important thing is to start a bit more in detail about what is asset-based data. So some of you on the webinar, this may be a completely new term. Some of you may know it very well, but just to clarify what we mean. So asset-based data is always referring to data that is aggregated from underlying physical assets. And when I say physical assets, that could be a power plant or a steel mill, or a vehicle, any sort of object in our economy that is a source of emissions. And at Asset Impact, this is really what we focus on these underlying things in our economy that produce emissions. And we always focus on these, on key sectors that are responsible for a large share of emissions. That could be like power generation, steel production, oil and gas extraction, all the key sectors that are responsible for global emissions. And the next question we often get is, why do we look at physical assets and not corporate disclosures? And actually, Asset Impact, when we first were set up, we started from the perspective of corporate disclosures. But one of the things that we quickly realized when we were looking at corporate disclosures as a source of climate data is that they're very inconsistent. There's an ever-growing body of evidence that shows that corporates don't have coverage in their reporting, the information isn't consistent, there can be methodological flaws, and this makes it really, really hard to build a comprehensive data solution for climate action if the underlying data source is not reliable or consistent. And so this is why we've chosen to really focus on asset-based data, because with asset-based data, we actually go down to the underlying physical assets that all of these companies own. And this is a really powerful way of looking at climate-related data, because when we look at physical assets, we can always have global coverage. That means we can cover every company within a sector, regardless of whether it's public or private, whether it has climate-related disclosures or doesn't disclose at all. We can look at this information from a very granular level, meaning that we're, of course, starting bottom up from each physical asset that is the source of emissions in the real economy. Another powerful insight with our asset-based data is that it can be forward-looking as well. So instead of just relying on the historical reporting of companies, we can build forward-looking projections that give financial institutions insights on where these physical assets are going in future, and most crucially, where the emissions for these assets are going. Another key benefit of going bottom up is that it's also comparable. Because we are collecting all of this underlying data and consolidating it ourselves, we're always doing this on a consistent basis. So we don't have to worry about arbitrary methodological choices or inconsistencies that companies have. We choose how it's consolidated, and it means when you're comparing, say, BP or Shell, you're always comparing them on a like-for-like basis. And the last point, which is, of course, very important to us, is transparency. Because we are collecting the data ourselves and consolidating it bottom up, we can provide our clients complete transparency on the methodological choices, the scope of the data, and essentially the completeness. So when a client like ING is using it, they always have visibility on the methodology, and they feel like they understand what they're using and are not in the dark. So that's a very brief introduction about asset impact data. And now I'll pause here and we'll transition to the actual panel discussion.
Thank you, Vincent. So maybe to start the panel discussion, maybe Meishuan, can you tell us a little bit of your experience within ING and why you've been using that type of data and your experience of using it compared to looking at corporate disclosures?
Yeah, happy to do so. So ING has been disclosing climate alignment dashboard since 2019. And of course, gradually with the improvement of data, we are also continuing to do so. What we have done is using different sector approach, of course. So for different sectors, of course, we also have different data granularity that we look into. For certain sectors, because most of our client relationship are general purpose loan, so then the need for asset level data is it's not that great. However, since these days we have seen a big transition towards a low carbon economy, and we also have publicly made commitment to up our renewable financing. So then we need more granular data on these specific sectors, like power generation, like commercial real estate, and for example, also aviation and shipping. They are individual assets that move around, but still they are asset-based data. So from our perspective, we have improved throughout the years from sector average towards corporate level data, and now moving to asset level data. I have to say it gives us a better comprehensive understanding of our own portfolio in the specific sector, that allow us also to do a bit deeper analysis and to identify the driver of the current performance. We are also one of the first banks to also disclose our change of drivers year to year in our climate report. And this all thanks to the better granularity of the data.
Okay, well, thank you for that description. Very insightful. Maybe turning to Vincent now. I think on the next question, so you have explained what is asset-based data and how it's structured. Can you tell us more about the type of indicators that you're trying to, or that you're collecting and consolidating on an asset-based level, and maybe why these indicators?
Yeah, no, it's a great question, and I think I'll start with the fact that when you're looking at asset-based data, there's hundreds of different indicators you can collect. You can look at climate-related indicators, biodiversity-related indicators. So it's an ever-growing world, and I think that's also what makes it very exciting. But focusing really just on the climate use case, there's really 4 sets of indicators that are core to a lot of use cases that financial institutions have when they're steering a portfolio towards a net zero target. So the first is emissions-related indicators, which is a very obvious one, and that's absolute emissions. So this is an indicator that's crucial for things like measuring your financed emissions, doing PCAF reporting, things like that. Then you have emission intensities, which are a great way to benchmark companies. So if you're trying to understand, well, one company may have a lot more emissions than another, but on an intensity basis, it may actually be lower than the other company. So when you're looking at its relative impact, emission intensities are quite crucial. They're also a great way to steer sectors towards a net zero target. And the reason why emission intensities are useful for some sectors is that, for example, in steel manufacturing, we know that under a net zero scenario, the sector actually needs to expand to meet global demand under a net zero transition. But we also need to decarbonize the sector in parallel. So what really matters for this sector is actually the intensity of steel, and that it's reducing over time. And so therefore, emission intensity is a useful metric. The other sets of metrics are related to the physical activities of assets. So that's, for example, production and capacity. And these are a useful way to understand how the assets are used. So whether a power plant is operating on a regular basis, so X gigawatt hours per year, or how much steel is coming out of a steel mill. And of course, these can be complemented with emission indicators to draw further insights, like producing emission intensities.
Yeah. Well, thank you. And maybe if we look again at the use cases of ING, can you also tell us which indicators you've been prioritizing, and whether, for instance, you're looking at the emissions level or at a more granular level, looking at production, or focusing on the intensities, as Vincent explained, and also why?
Yeah, we have this Terra approach, but we also call it a toolbox, because for different sectors we have different tools. But majority of the sectors we are currently reporting and also managing is emission intensity as the metrics, because we do believe that, like Vincent also mentioned, with the growth of one sector, if you use absolute emission to measure it, it is not, it does not reflect the needs that within a scenario they're demanding. Also, it's a great benchmark tools to benchmark metrics to compare company to company. And the only sectors we are using absolute metrics is oil and gas upstream, because according to the IEA scenario, we do not need no more upstream oil and gas anymore. So that is an absolute reduction. But for all the other sectors like power generation, like steel, according to the scenario and also the population growth forecast, we would need more energy. We would need more steel. So that's one of the reasons. But also, I really like how Vincent bucket them into different indicators. How we see from ING perspective, we kind of separate them into two types of asset-based data. One is the specific quality of the assets. So for example, what is the asset type? What is the technology? What is the location? It's like very fixed data points that will not change throughout the lifetime of the assets. And the second type is the operational data. So when you start to operation this asset, how much emission you start to emit. For aviation or for ships, how many mileage you have driven, and what is the capacity, the speed, the electricity usage of this specific assets. So these are the two type of asset-based data we look at, and also in different sectors we use accordingly. If I can just give a brief example, like in shipping, we do look at ships, and we all know the newer generation the ship is, the more efficient they are. So therefore, less emission would emit. However, that's just according to the first type of data, the specifics of a ship. However, of course, ships are operated by human, and it requires a lot of experience to correctly operate this newer generation ship. If you speed up all the way and stop at the port for a couple of days because there are no parking space in the port, then your emission would even be higher than the older generation ship. So these type of balance and metrics to be considered in the asset level data is also crucial for ourselves when we measure our portfolio performance.
Okay, well, thank you. Very, very useful example as well. Maybe one last question on the indicators, and maybe turning to Vincent again. But so you've talked about the type of indicators and the two groups of indicators that you're looking at on the asset-based data. Can you tell us a little bit more on the forward-looking part that you mentioned in your slides, and how it can be, how the values can be projected, and how, again, doing it in an asset-based level helps in terms of accuracy and also projection then.
Yeah, no, it's an interesting question. I think it's also one of the things that makes asset-based data extremely exciting, because you have this forward-looking component. And how this forward-looking component is built is always with a sectoral perspective. So different sectors will require different forecasting models and methodologies. So that's one thing that's important, is that, although we look across sectors and we consolidate this information, when we're looking at an individual sector, we do need a sector-specific lens and expertise to develop a model for that. And so the methodologies vary quite a bit, but it's basically, we're looking at a wide range of characteristics for each asset. It can be when the asset came online and when it's expected to come offline. It's historical production trends. as well as production trends across the sector. It can be macro and microeconomic drivers. All of this information is consolidated into a specific methodology. And then for each individual asset, and we cover about over 300,000 assets in our database, we build a projection or forecast for that asset into the future. And that forecast can range between 5 to about 17 years. And this basically shows where the assets is expected to go in terms of its production and emissions. This information can also be split across scope if you want additional insights in terms of where those emissions are going. So you may see scope 1 declining in future, but actually scope 3 is staying stable or increasing. So this allows you to draw really important additional insights on how transitions are unfolding. And it's a very powerful thing to actually see live in our data, because you can see that for two electricity power generation companies, both of them may have net zero targets. But when you look at the forward-looking data based on a projection as well as their announced plans and commitments, one company is clearly transitioning and building out a massive renewable portfolio, while the other company may not be transitioning. It may be retiring coal, but continuing to build out gas. So for a financial institution, this is a really crucial insight, because that is the first step of risk management when it comes to a net zero transition, is identifying which companies are actually transitioning versus which companies have made a commitment but have not actually started to act on that commitment. And that will really determine who are the leaders and the stragglers in this transition.
Yes. Yeah, thank you. I think it's also very useful insight you get on companies using that type of data. And then I'm gonna ask Meishwan about the use of these projected views, and maybe you can also give us some examples of use cases at ING. So you've already introduced them in the first question, but maybe in more detail how the data is used for net zero, and then maybe also the projected part, especially how it can be used to set a target and to track how you're progressing.
Yeah, of course. So this is a interesting part indeed. Like Vincent said, it's a powerful data that can tell us where our clients are going. So for the forward-looking data, we mainly use this as the starting point for client engagement. So, for example, we have a department, Sustainable Finance, who specifically do client outreaching. And it is important to know the clients that are currently in our portfolio, are they with us transitioning to a net zero world or not? Because one of the key principles Terra also uphold is engagement-based, because we do not want to say goodbye to our clients. We want to transition all together to a low carbon economy. However, if we do not see the willingness or the ability to transition, then like you said, some risk measure needs to come in, or some hard choices needs to be made. And in our also climate report in 2023, we have disclosed that we start to build this tool for a client transition plan. So we collect from our clients what are their plans for transitioning. Of course, we start from a very focused group, and then the most carbon intensive, to say, and then to collect data, and of course using the asset level data also to validate or to start a conversation with the client, saying, okay, I see in your report this is your plan, but in our other data set, this is what I'm seeing. How should I understand this? That's really struck a very meaningful conversation. So then it also fulfilled our engagement based principle of Terra approach.
Yeah, I think it's very good that you mentioned the client engagement. And well, I think my next question is just to follow up on that, because as you said, you engage with a client who has reported something which might look a bit different. And can you tell us a bit on the reconciliation part? So on your side, so on your side of the analysis of the data, how do you reconcile or analyze when data which is asset based looks different than the data reported by the client? And how do you make that analysis, and what kind of things you've noticed while doing this analysis? And just reminding the audience to not hesitate to ask any questions. So you have still the chat box available. So please free also to ask questions for our panel speakers. Yeah.
Yes, when we do the data comparison, very luckily we have Vincent on the other side to be on our counterparty whenever we have questions. That we first, of course, to just see, could the scope be different? Could it be just the location base, or is just simply the client is reporting a different year in their scope? And often that's the case because client has a specific scope that align with their financial reporting or their operational scope. So then it could be different than the data we are procuring. Yeah, and sometimes we also cross-check with European bureau. Like there is one database that within Europe that you can check. For example, for automotive, you can see for each different car model what is the emission intensity, and then you can also do a bit of benchmarking ourselves. Yeah.
Oh, thank you. So then I guess the next question is for Vincent. So how, well, it's a topic that we get very often from clients or people we talk to about what to do in case of differences with a corporate report and what the reasons could be for differences. So can you tell us a bit more on how you do the analysis and what are the main reasons for differences that you've noticed? And I think that's also linking to the first presentation you made on limitations of corporate disclosures.
Yeah. So it's something that, as Michelle, you mentioned, it's a very common question from clients. And I would say there's three key drivers behind it. And this is also how we frame our analysis when we're trying to understand the differences. And the first thing is every corporate discloses differently. So it's very hard to find a set of corporates that have the exact same methodology, exact same scope. They all have their own flavor. And so we need to understand that flavor to first understand if there's differences. So the first thing we look at is in terms of consolidation. So how is the corporate consolidating their information about the underlying asset level data to produce their climate reporting or emissions reporting? And that consolidation has to do with accounting approaches. So whether they're using financial control, operational control, equity ownership. So these are just basically accounting rules of what you include or exclude in the corporate structure. So for example, if you include minority stakes in subsidiaries or you exclude them. These are very pedantic details, but they can have a massive impact on the figure. So if a corporate uses one consolidation approach versus another, that can have a 25 to 50% impact on the value that they actually disclose versus if they had used another approach. So this is something that's really important to understand as a first step. The other aspect is the scope and methodology. So corporates may choose to arbitrarily include one segment of their business, but exclude another. And that can be, they don't necessarily need to provide a rationale. It's just what they choose. So they also can decide on the narrative, which is sometimes a little dangerous. But that also means we need to establish first if the scope of the data is consistent with ours, as well as the methodology. And once we've looked at those two parameters, and we figured out if they're actually truly aligned, then we look at the actual consistency of the data. So we're also very open to our clients' feedback. So if there's inconsistencies in our data, that's something that we find as really important information that we take into account. And it's something, for example, with ING has been an ongoing dialogue for the past 3 years. So in that case, then we'll look at individual assets, individual subsidiaries that are part of the corporate to basically understand what are the differences. And those differences can be, for example, that a power plant has a year offline, which is different than what the corporate has announced. And these are things that we're always integrating into our database and updating on an ongoing basis. And this is really also the powerful thing of asset-based data. It's not a fixed thing, it's a dynamic living thing. So you can always integrate new sources of information. You can expand the coverage, you can implement updates and fixes. So it always gives financial institutions a live view of what's happening in the real economy and the flexibility to improve the data.
Thank you. So I think we have only 2 minutes left in the panel before we move to the audience questions. So again, don't hesitate to post any question. Maybe some final words on how it's used. Meishuan, is there any other use case that you would like to share with us, or from the ING side, or maybe things that you would consider in the future, and that you see where asset-based data can be useful?
Yeah, definitely. I think when we are searching for our data, first of all, we have to search for the data that's compatible to the methodology we are choosing. So we should have the correct scopes and the reasonable assumptions when we contracting the data. And secondly, most of the time we have to do a data coverage test to see if we have enough data to cover the scope we are trying to disclose or analysis. Also, sometimes we will test and measure the asset level data against, like also mentioned, the company's own disclosure or regional governmental database to do a coherence test before we can, let's say, confidently use the data. And I have to say, with the asset data, still, it's quite challenging to match between the external data and the internal data. But this will be a continuous improvement for any organization, I believe, to do so. And I think in the future also for business steering or target setting, we will use more granular data to do so instead of generic like regional average or proxy data, because that does not tell you the full picture of how your clients are performing or how is your portfolio are doing. Yeah.
Okay, well, thank you. Any other last point you want to mention, Vincent, before we move to the audience questions, or we're fine with the description of the use cases, maybe things you've seen with other clients as well, on benefits and the use cases?
I think maybe just building on what Meishuan mentioned is that the use of asset-based data is really, it's a new field still. It's always evolving, and I think that's also what makes it exciting. So we see it's a very dynamic process, and for example, it's been really amazing to work with ING because they're really leaders in the use of asset-based data. So each year you can see their reporting process evolve, and there's more insights, there's more sophistication in their analysis and expanded scope. So I think it's really an important thing to observe, that it's not a fixed thing, it's not final, but it's evolving and it's improving, and we'll be able to achieve ever more insights from this really detailed bottom-up data.
Oh, thank you very much for that conclusive words on the panel. So we are going to move for the last minutes of this webinar on the audience questions. So I think we didn't have new questions from the chat box, but we had some questions which were recorded when people registered. So I would suggest we go through that list of questions. So we have a first question on data quality. So the question is, what is the data quality of the asset level data? Is it reported? Is it estimated? And how do we, do we have methodology documents, and how it's how is this methodology built? And I would also add, maybe, how are we making sure of the quality and accuracy of the data? So I guess maybe a question for Vincent to start with.
Yeah. So I'll maybe start with the sources of the data. So our goal is always to start with reported data or actuals. So that could be, for example, a consolidated power data set on the annual power generation of power plants. So that's actual information that we can rely on. That information is not always available, and that's a reality that we have to address proactively. And that in that case, we use estimations. Those estimations are always based on these sectoral specific models. So we're always starting with a physical asset and a range of characteristics, and from there we can build an estimation or forecast. That's something we try and be very transparent with our clients about, because we want them to know when it's an estimation model for a sector or whether it's actual figures. And so we always share methodology documentation, and we try and engage with them in calls and other discussions to make sure they understand what they're using. And that's really important to us, because that also communicates the level of insights and reliability in the data. And because clients are making key decisions, like steering the portfolio towards net zero, that process is very important to us.
Yeah, thank you. And Meishuan, maybe on the data quality, can you maybe tell us a bit on how you are making sure of the data quality on the ING side, and what are the challenges, but also the benefits you noticed when looking at data quality?
Yeah, definitely. So from ING, because we're a bank, so we're a highly regulated body, and as I guess everybody have noticed, more and more regulation and disclosure requirement are here for banks and also all the other companies to disclose their data. Of course, internally we have our own policy on what is the data quality, how to do so. But before we come to that stage, we just do what mentioned before, some data quality cross-check, and also checking the methodology, and also, of course, engage with data vendors to understand what is truly included in the data set. Of course, with this high demand on disclosure requirements, we are very keen to have some standards on data quality for climate data, just in general. If there are, so in the best practice, at least in the market, is the PCAF for emission. You have PCAF score, and for CDP, you have the CDP score. However, it is still a highly flexible market in the data sense. So we are also very keen to know, or to be part of the change that can have some unified data quality standards in the climate data, so then everybody can follow.
Yeah, I think it's a very good point as well. And I think, as Vincent mentioned, this is a new field, but I think in general, the climate measurements is still fairly new. So defining standards will really be a way to move forward and to improve the quality of the data in general. I think we had a question in the meanwhile on the chat, so on a different topic, but still I think relevant to asset level data and building indicators bottom up. So Vincent, this is about biodiversity. So the question is data available already with the same asset level approach? And if so, how many pressure factors and considered, and are you able to link the costs of polluting diverse ecosystems with its asset-based origins? I think we've talked a lot about climate, but this is also very relevant question.
Yeah, it's a very interesting question, and at the moment, our data is really used as an input into biodiversity models that are trying to estimate what are the impacts of these physical assets on their surrounding environment. So we don't have specifically a biodiversity solution, but you do see the space overall evolving quite rapidly. There's the Task Force for Nature-Related Disclosures. There's a nature climate action initiative happening as well. So I think we'll see a lot of growth in this space in the next few years, and it's something that we're definitely interested in being part of, and seeing how our bottom-up approach can relate to that.
Yeah, thank you. Very, very useful as well. Then we also had a question on regulatory reporting or regulatory requirements. So something you briefly mentioned as well, Meishuan, in your last answer. So I think especially, the financial industry, but especially banks have been mainly disclosing climate targets on voluntary basis so far. And what we're seeing is the pressure from regulation is coming more and more. So can you tell us a little bit of what you see in that space and what kind of regulatory requirements you're foreseeing, and how asset-based data can also be used to report them?
Yeah. So even though there are voluntary ESG disclosure commitment, we see actually for the even voluntary one, companies starts to do a limited assurance on their reports, not only because the NZBA has this requirement, but also it just increased the credibility of your report. But when it comes to regulatory reporting, of course, everything has to be done properly. And I do see the reluctance of using too granular data without assurance, because it's just very hard to explain. Rather would choose a bit high-level data with assurance. So that's one of the trade-offs that we have to do. And I guess many financial institutions may also have to consider. But we have to also be clear on the purpose of why do we use this data for what. So when it comes to reporting, or especially regulatory reporting, we have to use very reliable data. That's just non-negotiable. But maybe for target setting or internal business steering, we could explore a bit more granular data and using asset level data better. Mm-hmm. That's also just my 2 cents.
Okay, well, thank you. It's also a very, very good insight. So I would say we are now at the end, so I don't think we'll have time to cover all the questions. There was one question as well on training or articles that we can share on the subject. So I guess for the questions we have not been able to address, we will send you individually by email some answers. So don't worry about the questions. We'll make sure that you get some answers. All right. So thank you very much, Meishuan and Vincent, for this panel discussion and addressing some of the key questions. I think it was very, very useful, very insightful in terms of how climate data is being used and what is asset-based. I would say asset-based data, so asset data built bottom up, and the issues it's addressing in that space. So I hope everyone on the webinar could get some useful information about it. And of course, if you have any remaining questions, or if you're interested to know more about this type of data and if it can be useful for your organizations, we will follow up after the webinar with the recording and some presentation. And you can, of course, feel free to contact us. We'll be happy to set up individual discussions. So thank you again, and hopefully talk to you soon.